However, we are continuing our theme of Wall Street versus real estate. We got a great guest coming up for you right after this. Greetings. It's Bill, and it's Jonathan, and we are Carolina Management. Welcome so much to the what show again? The real estate investor show. Hard money for real estate investors. Carolina Capital Management. Once again, we are private lenders for real estate professionals Southeast. If you have a project rather that if you'd like us to take a CarolinaHardMoney.com. Click the Apply Now tab. If you are a passive investor looking for passive returns, click on the accredited investor tab. Don't forget to like, share, subscribe, the bell, and don't forget about Wendy's with Wendy. Wow, nice new graphics. I like this because they always keep us on our toes. Secondly, Wendy devotes 30 minutes of her time per person each Wednesday. Anything real estate related, there's a link there to get on her calendar. She's usually a couple of months in advance, so good book now. And I'll talk about the up and coming Expo. Hey, so Quest Expo, it will be on the 22nd, 25th, I believe. 23rd through the 25th of September, and the keynote speaker is Emmett. Cool. I've got a chance before. Emmett, a real estate entrepreneur after football. Mm-hmm. So he's got a really interesting story. So you can get there. We have a code to get 50% off. It's Fairman. It will be over in the comment section. From what I understand, our audio is really freaking out. So I'm on Chris really quick because not only have a better voice than the rest of us. Yeah. He's not having the technical difficulties that we are having. Chris Miles with Money Bulls. What is your title? The anti. I think you're muted though. Let's let you.
My anti-financial advisor, right?
Anti-financial advisor. I don't know why I keep saying that. But welcome to the show. Thanks for coming on again, and I apologize for our audio.
Hey, no problem.
Issues.
It's kind of like listening to Max Headroom. You know, if you remember him from the 1980s, like Max Headroom. You know, it's kind of like that. So I think it's kind of cool, actually.
Oh man, you got back some not so fun memories. but I did love. Okay. So our theme this month is about being able to build wealth in real estate versus getting rich in the stock market, right?
Yeah. The premise is what builds more wealth, and when we say wealth, generational wealth, cash flow, everything. I mean, like before it was risk, like the risk mitigation side of it, like you can get rich really quick in the stock market, but you can also lose really stock market, and knowing how to play that. Whereas real estate, it's more of a long marathon, and marathon's appropriate, I guess, for Chris, but
yeah, because he's running these marathons. All right, we're going to stop and let you say something. But first of all, talk about your story, where you started, and what you're doing now.
Yeah, I started not learning about money, right? I was raised by great parents, taught me good values, but the one thing they really didn't know a lot about was money. And when it did come to money, it was usually about scarcity. right? I remember sitting around the table and, although my dad would say, hey, you can be anything you want to be, right? But then he would also say, we can't afford this. Or what do you think I am, made of money? Money doesn't grow on trees. And then even hearing things about his work, saying, I'm going to work until I'm dead. I mean, like that was like his outlook on life. It's like he was going to die working. Now, understand, he was like the quintessential saver. He was like the perfect saver. In fact, he would be like Dave Ramsey's older brother, that taught Dave everything he knows. Because my dad was not just a big penny pincher, he saved everything. Although, he did splurge every once in a while, but he pretty much was a big time saver, paid off his house early, very proud of that, saved in his 401ks, did everything you're supposed to do. But again, he was always talking about money being a scarce thing. And so, like most kids, when they see their parents, they say, I'm never going to be like him. So, as I became an adult, after doing some college and everything, I decided to drop out, become an entrepreneur, and I became a financial advisor. And so, as a financial advisor, started to learn the things, hoping that if I learned something different, that I would be able to help give my dad some of his life back. Now, the problem with this is that after several years, I sit down with my dad at his kitchen table. This time he's asking me for advice. He says, Chris, I'm 61 years old. I want to retire. What do you got for me? What can we do here? And I looked at everything. He's debt free. He's saved in his 401ks. And I said, Dad, here's the deal. If you decide to retire today, you have to die in 5 years because you're going to run out of money. Luckily, you got a little bit of Social Security, so they can help push you along a little bit longer. But if you didn't have Social Security, you'd have to die 5 years after retiring. And he said, okay, well, what do I do? I said, I don't know. You've done everything right. Everything that I was taught as a financial advisor, you've been doing. And this really disturbed me because as I'm looking at this, I'm saying, wait a minute, he did everything right, yet he's still not financially free. And then I start looking at my own clients, even clients I inherited from decades of previous financial advisors. They were in the same boat. They weren't financially free. And then I started looking at the financial advisors around my office, even the guys that have been working there since the late 1970s. And they weren't financially free either, unless they have commissions coming in. But without the commissions, just based on mutual fund investments, they wouldn't be financially free. And then I looked at my own life and realizing I was on the same exact path as my dad. Even though I vowed never to do what he did, I was trying to be cheap. I was trying to save everything. Hopefully, if I saved up a couple $1,000,000 by the time I was 40, I could live on a whopping $60,000 a year lifestyle, $5,000 a month, which I thought was amazing 20 years ago. That's not the case today. And I realized there was a big problem. And of course, when the student's ready, the teacher appears. That's about the time that that I started to meet guys like you, guys in the alternative real estate space, people that were doing things in the real estate game that were retiring in like their 20s and 30s, financially independent. And so I started to learn from them, started doing some of those same things, learning is about cash flow, not about accumulation of money. And the next thing I know, I'm able to become financially independent myself when I was 28 years old. And since then, I've been teaching people how to do that today, as like the anti-financial advisor, telling people to go away from the stock market. Now, understand, even in my background, I mean, not only was I pro stock market, pro mutual fund, I was also pro stock trading because I was also, by the time that I was right about the transition between becoming financially independent and quitting as a financial advisor, kind of in that middle section right there, I also became a stock coach. I was teaching people how to trade stocks and options in the market so they could be like George Soros, right? Or some people would claim Warren Buffett, but Warren Buffett doesn't trade stocks. He buys companies. It's different. And so I was teaching people how to do that stuff for a few years as well. So I trained about 200 people just one-on-one how to buy and sell stocks and options. And I'll tell you, even being in that world, having been there, I can assure you that just like in the financial advisor world, although you have more hope if you do your own stock trading, the truth is that even the best traders in the stock market will not do much better than 20% a year. That's it. Now, 20% is nothing to shy at, right? But when you hear people out there saying, oh, I make hundreds of percents on my trades, or there's even people that try to raise capital and funds saying, I'm doing options trading, I'll pay you 10% a month, which is bull crap. They can never do that. Every time that's happened, every single time I've seen somebody get shut down by the SEC because they can never sustain it unless new money's coming in because it's basically like a Ponzi scheme, right? So you hear all this kind of crap out there, but the truth is that George Soros himself has only done about a 24% average over time. That's why he's in his really about 90 years old and he's a billionaire. Still not the top of the list. He's up there, but it took him 50, 60 years of this. Warren Buffett, same thing. His average has been about 24, 25% buying companies, buying interest in those companies, and watch his portfolio grow. He's also nearing 100 years old, and yet he's still about the richest guy in the world, right? So the truth is that if you go with Wall Street, you're going to have a much harder time of success because most people aren't investing like this. Most people are putting their money in mutual funds, which the S&P 500 for the last 30 years has only averaged, and I just updated this, about 7.75%. That's without fees. That's without taxes. That's without anything going against it. Most people in mutual funds don't even get that high because almost the vast majority of mutual funds never get the height of what the S&P 500 does. They usually do a lesser return. So think about that compared to a 401k fees, it's ridiculous.
The S&P 500 average, was that inflation adjusted as well?
No, not inflation adjusted. That is the true actual yield of the S&P 500. So when people tell you 10 or 12%, that's bogus. It's bull. It's never been the way. And I was taught that as a financial advisor, and yet I found out that wasn't the case.
Well, I know I've had conversations with others as well about 401ks, and we had a conversation recently, and anecdote speaking, I don't know anyone that has made, and this will do in the week, but anyone who has made more on their 401k than what they've and what their employer has over, say, a 20-year period. And again, it's anecdotally, but the gains I see in the 401ks are distributions and the free money you get employer, not really from the market.
It basically boils down to a little better than your bank saving account.
It's true. I mean, even the 20-year average of the market, it's even worse than that. It's less than 7% in the S&P. But you're right, because 401ks, the average fee, fees will vary in 401ks. Sometimes the larger corporations, if you have tens of thousands or hundreds of thousands of employees, sometimes it'll be between 0.5% to 1% of a fee, right? Which is good. But there are some 401ks out there that I've seen that are like between 1% and 2% a year that you're being charged, whether you make money or not. Some are even over 2%, right? So think about this. Even if you happen to get close to the S&P 500 returns, most likely because you have a variety of mutual funds or you're in the whatever target age fund that you're in, you're lucky to pull off 7%. But if you have a 1% fee coming out of your 401k, that means you're only netting a 6% return. And of course, you throw in inflation in there, which we all know is a lot higher than 2 or 3%. We're looking more like 5 to 7% minimum average, right? You're right. Like you're maybe just keeping up with inflation. Funny enough, I didn't realize we'd be talking about 401ks because the argument everybody always talks about is the match, right? Like, yeah, but I get the match. Now, if you're your own employer, like you're a dentist or something like that, the match is really ridiculous because you pay your own match. You really don't get anything. There's no real argument for that. In fact, you'd be better off just buying your own mutual funds outside of a 401k plan because it costs you more money than just investing yourself.
Yeah.
But for those that are employees, they'll say, yeah, but I get this 100% or 50% match on my money. For every 6% I put in, I get 3%. In the rare few cases, you might put in 6 and get 6. And that's usually the best I ever see. Funny enough, I was actually just getting ready to record my own podcast to release about 3 weeks from now. So you guys are going to get the sneak peek. But I ran those numbers because what people always say is, let's just say you get that 100% match. They'll say, but guys, this is a 100% rate of return. You can't beat that. That's free money. It's brainless. And you're right. It is brainless if you just think it's free money and you think it's 100% return because you put in 100% compounded return in a calculator. You can go to calculator.net and do this. Go put in a savings, interest-bearing calculator. Put in 100% a year, putting in, say, 6,000 a year. Say you're putting in 6,000, get 100% return. You'll find out you're going to be richer than Buffett or Bezos in the next 30 years. I can promise you at 6,000 a year, you will never be a billionaire, multi-billionaire. But that 100% return, because it keeps doubling every year, makes it look like it. What you're actually getting is a total 100% return. Whether you invest for 1 year or 40 years, you only double your money with the match. And so you run the numbers, like you're putting in, let's see, actually, I think I ran those numbers. Let's see, I put in, 6,000. So I was doing one where I was putting in 6,000 a year, making 6.5%. I was being pretty generous for people that believe they get a higher return on their 401ks. 6.5% for 30 years, you will have 1.1 million when you get the match. But the funny thing is, if you only put in the 6,000, not get the match, you have 550,000. So you have exactly half the money. So you only double it. And with the whole rule of 72, right? That 72 says for every 72 years, whatever the interest rate is, it doubles. Well, if you save for 40 years, that means it really only adds a few percent return to that 6.5. In this case, when I ran it, because it was that full 100% return, it got you from a 6.5% return to a 10% return. So it actually gave you a 3.5% over 30 years. The shorter the term, the better. But you and I, we all know we could do way better in the alternative space. And it's not about accumulating that money, because even if you got the same, and I even showed earning 10%, for example, in alternative investments, you would have the exact same number as a 401k. If you only put 6,000 a year, you wouldn't have the match, but you would still match what they made. You'd have about 1.1 million. Here's the difference. When you're in mutual funds, right? Obviously, you're not earning those aggressive returns when you hit retirement. When you hit retirement, you got to start taking those conservative returns. So even Wall Street Journal last October said, don't believe in the 4% rule anymore. That's too much money. You will run out of money with people living longer. You should only pull out 3% a year. So if you have 1.1 million, that means you're actually only pulling out $33,000 a year. Where if you're earning 10% on 1.1 million, you're pulling out $110,000 a year. Because if you're in alternative investments, just like you guys have with your fund, you got regular cash flow coming in, paying, you know that that's going to pay way more than 3%, right? You're going to pay more than that, and it's not even touching the principal. Where most people are pulling out 3%, and they could very well be touching the principal depending on what's going on in the markets, pulling money out, hoping not to run out of money by the time they die. It's a very different mentality that, I didn't even understand as a financial advisor, because I was in that accumulation mindset. But when I got in that cash flow mindset, totally different.
Yeah, I mean, some people are taught to, like the biggest lie of the finance is put money in your savings account. Like put all your money in the savings account. Please have some, but like save it. Just save it. Just then with the 401k, just put it there, and it's there. And it's like accumulation of money is, if you live in a capitalist society with inflation, it's worthless.
Yep.
Put it there. Like you can put it into an asset that has a tax depreciation, that cash flow and builds a. It's like people just don't know that you can lower your taxes, create wealth through appreciation that you can do later, and all while having cash flow along the way. Like
that's right.
Yeah, 401k can't do that. I mean, savings account can't do that.
And the average person have the network in place to go and buy these properties and do this stuff on their own. So that's why there's different funds that you can get into and still achieve the same benefits, because now you're an owner in a fund that owns properties, and then or
that's right.
Lends money on property, that type of thing. So you're still getting all those the upside and the time.
Let's see, Chris, you want to take that?
Let's see. Can you take the match and move the money out of the 401k into another retirement vehicle? I suppose maybe some want you to keep the money in there until you leave the company. Good question, because the truth is, with a 401k, if it's with a current employer, you can't get it out, right? Like it's locked up in prison. I actually tell the people that most of the time what you're taught traditionally with money is to keep your money in prison. Lock it up in home equity. Don't take it out. Pay off that house, right? Lock it up in your 401k, which you can't get to unless you get fired or quit. Don't recommend either of those necessarily, right? I mean, everything's just locked up, and that's what the banks and the financial institutions want you to do, because they want the money in their possession, not yours, right? So yeah, with a 401k, can you move it? Yeah, when you leave a company, if you change jobs or anything like that, then yes, you can roll over to a self-directed IRA. And now you've got a lot better options in the alternative space you can invest into, which definitely are great. And of course, you guys just advertise the Quest Expo, which is a place you can roll your money over for that, IRA, self-directed IRA.
There are some plan administrators that will allow you to take a portion out and self-direct. That's very rare, and a lot of times direct is not really self-direct. Here's a basket of funds that you can choose your money into, and that's not taking it out of the market.
Yep, that's true. Yeah, if you're over the age of 59 and a half, so you don't have that 10% withdrawal, penalty that you have. There are some rare situations. You can ask your HR manager if you work for an employer and ask them, can I take what's called in-service distributions? So if you ask about in-service distributions, it means you can actually pull the money out of your 401k while you're still working there. Now, if you're the employer and you own the 401k, there's lots of things you do to either dismantle the plan and then roll it over. Or you can do other things with it too. I know I'm actually working with a dentist that both of us know that he's saying, I don't want to get rid of this plan now. This 401k plan is useless. None of my employees care. I even gave him the idea. I said, well, what's your match? 3%. Like, why don't you just tell your employees, effective today, I'm giving you all a 3% raise. You do with the money whatever you want. Pay off your credit cards, go blow it in Vegas, whatever you want to do, save it in your own retirement plan. That's going to be less in fees than getting this 401k plan. Do something else, or, do a once in a year trip with the couples. Like, I know one dentist that actually took that 401k plan, got rid of it and said, you know what, instead, we're just going to go do Carnival Cruise Lines over every Labor Day weekend. And we're going to get drunk off our butts for a few days and then come back to work, hopefully not as hungover, but, just do that. And the crazy thing is, like, they actually have the best recruiting ever. They never have to fill a position because once they know there's a position open, all the employees are going out saying, you got to work for this company. It's so awesome. Once a year, we go on this cruise, we get drunk off our butts. It's great. So there's a lot of options you can do besides 401ks.
Oh, I'm sorry. We're pretty sure that's not on their dental website.
Yeah, that's right.
There won't be anybody scheduled for that Tuesday morning.
Exactly.
Talk to us about how you're instructing clients on cash flow through products.
Yeah, I kind of give people the three key pieces of advice: is get lean, get liquid, get out. Right. Get lean just meaning, like, let's get really responsible, understand how much money is coming in, how much is going out, tracking your money. I think using tools like Mint, mint.com, or there's the app Mint that you can use as well. Great tool to use to be able to just track your money, see what's going on. I mean, really get clear on that, because the more you can put away, the better, especially the more you can put away outside of things like 401ks or outside of trying to pay off your house aggressively early, things like that. If you can get that money in your possession and in your power, now you have options to be able to use that money. So that's one, is get lean. And get lean means don't necessarily be cheap. Don't live on rice and beans. I don't mean that. I don't mean even giving up that latte like other people will give you advice for. It just means be a wise steward of the blessings you've been given and prioritize it. Two, get liquid, right? That means it's kind of the same thing I said, is let's get it into savings. A simple place could be savings account. I even teach a strategy called infinite banking, where you can actually get a tax-free savings account that will actually allow you to double dip on your returns when you invest with it. But basically get liquid, get that money liquid and available. And then get out means, where's their money trapped, right? Is it trapped in IRAs, or like old 401ks or something like that, or Roth IRAs? Is it trapped in home equity? Can we get that money out of those places and then deploy it into alternative investments? And there are so many that you can do. I mean, obviously you can do lending of sorts, right? Or funds, things like that, where like Bill had just mentioned, going and putting that money in a place where they're managing it, they're creating the returns. You create a real, true passive income from that, right? And it's awesome when you can get, high single digit or even double digit returns potentially on those kind of things. There's things like, if you don't want to buy and be the property manager, because everybody wonders about rentals. They're like, yeah, but I don't want to be the property manager. Well, then don't, get a turnkey rental property where somebody else manages that for you. Again, you buy it and collect the checks. Same thing there. I was actually running numbers on that, comparing that to the 401k. just with some of my properties the last 3 years. I was comparing it with the stock market from 2019 till 2022, compared to when I bought a property in North Carolina, right in your guys' neck of the woods, right? And funny enough, my total return on that North Carolina property there in Fayetteville was actually a 200. Oh, wrong one here. There we go. It was without appreciation, it was a 60%, like 60% ROI without any appreciation. That was just having my renters pay down my mortgage a few $1,000 and earning all the cash flow. With appreciation, which I definitely won't deny, it made it a 218% ROI. If I had that same $27,000 down payment that I put in the S&P 500, I would have had a 42% ROI. So I basically have like, over $80,000 of the property where I would have had about $38,000 in the stock market, right? From 27 to 38. So, I mean, hard to beat that. I mean, I was already beating the stock market without any appreciation, and that was just the icing on the cake, right? So I look at that.
Over time, you're going to end up with a free and clear property. That mortgage will be paid down, and then you're getting more cash flow, and that property is going to continue to go up in value. You're going to get cash flow time that is going to increase. Rents are going to increase,
Right.
and then properties are going to increase.
That's a good point, because because the other thing I'm doing too, that 27,000 was paying me about $300 a month at the beginning, but now it's getting up to about $400 a month of net profit that I'm making. And I think they're even talking about raising it again because rents jumped up like 15% or 20% in that market over the last year. So they're saying, just to keep up with market rents, maybe we'll go in between, maybe we won't quite go as high as market rent, but we can still go pretty low. And for this long-term renter that's never moved for the last 3 years. So yeah, you're right. And that's all tax free. Where if I'm in the stock market, I get the full on biggest tax I could possibly get, especially if it's in a 401k or an IRA where it's ordinary income tax, the worst tax bracket you can be in. Here, I haven't paid taxes on this money because I've been depreciating the property, right? And all those profits have been getting written off. So it's awesome. There's other things like syndications. You can pull your money together, kind of like funds. You can pull your money into certain specific deals, whether it be like self-storage, it could be apartment buildings, it could be commercial buildings, it could be oil and gas. I mean, there's so many things there. In the last year, I even bought raw land, where I did a business partnership with someone who's buying and selling raw land for me. I'm financing it, but they're doing that. And I'm making great cash flow on that right now too. So there's just so many more options that when you take that red pill, right? That matrix red pill, you take it, you realize there's so many more options than in this tiny little Wall Street world of mutual funds and bonds and things like that. It's just, you really realize you're just eating really, really bad, British food. It's like British cuisine, like, wow, I got shepherd's pie, but there's no flavor here. It's kind of like that with Wall Street. It's like, this is all you're giving me. You give me mutual funds, stocks, bonds, annuities. But that's it.
I tell my wife that you're dissing shepherd's pie. Anyway, thank you so much, by the way, for joining us. You have a podcast. It's a podcast as well.
I do. I have the Money Ripples podcast that I do. Have 2 episodes a week come out, and yeah, it's a great show there. Plus, even our YouTube channel, the Money Ripples channel, we've got videos coming out every day. So lots of good stuff you can check out there.
Do you have anything you wanted to ask?
I was going to tell him thank you for taking the lead since our microphone connection, we're not sure what it is causing a disturbance in the force.
Not at all. I love it. Appreciate you guys having me on.
Thank you so much, Chris.
I do want to ask, everyone out there, anecdotally about collectively, we still haven't talked to somebody who has exited a 401k or like vehicle in retirement with more than their contributions from their employer. The question is, is there someone out there that different experience than that? We would love to know if you have received more than your contributions when you exit that retirement vehicle.
Yeah, and we'll give answers. Nico, just put it over there in the comments, either in the live show, or we'll continue to check those, and then we'll give the compiled answers next week. again, thank you again, Chris, so much for joining us. We really appreciate it. You always do a wonderful job. I'm trying to exit to my exit camera, so I'll see you shortly. So, folks, thank you so much for joining the Real Estate Investor Show. We are Carolina Capital Management. We are a private lender in the real estate space, real estate professionals. If you would like us to take a look at one of your projects, please go to carolmany.com and click on the apply now. But if you are a passive investor looking at returns, click on the accreditor tab. Don't forget to like, share, subscribe, hit the bell, and don't forget about Wednesdays with Wendy. We will see you guys next week with better audio. Take care.
Hey.